Today, we're backtesting Connor's two-period RSI. This mean reversion trading strategy patiently waits for sharp pullbacks within a long-term uptrend, then buys the dip and exits on a quick bounce. We'll compare it to simply buying and holding the S&P 500 from 1996 through 2024. This is backtested strategies, real tests, hard data, no spin. If you want to see how trading strategies behave in rigorous backtests using professional tools and data, you're in the right place. Connor's two-period RSI trading rules. For this backtest, we're using daily bars on SPY from a professional data provider with prices adjusted for splits, dividends, and other capital actions. This trading strategy uses three indicators. First, a 200-day simple moving average, or SMA. That's our long-term trend anchor. Second, a 5-day SMA, which we use as a shorter-term trend filter. And third, a two-period relative strength index, or RSI for short, with an oversold line at 10. A buy signal occurs when three things line up: prices above the 200-day SMA, below the 5-day SMA, and two-period RSI is less than 10. That flags a short, sharp sell-off within a longer-term uptrend. When all three of these conditions are true, and there's no open position, the system buys SPY at the next bar's open with 100% of available equity. A sell signal occurs when price closes back up above its 5-day SMA. At that point, it sells the entire position at the next bar's open and moves to cash. So, the idea is straightforward. As equities drift higher during uptrends, they often overshoot to the downside during corrections along the way. This strategy attempts to turn those corrections into a systematic, short-term mean reversion trading system. Each strategy starts with $10,000 of capital. The evaluation window runs from the start of 1996 through the end of 2024, using whole calendar years. That's nearly 3 decades of data, spanning multiple bear markets, many powerful bull runs, and some sharp volatility shocks along the way. Signals are evaluated using the closing price, and all trades execute at the next day's open, so there's no look ahead. Every trade pays 1 basis point per side in costs, 1 to buy and 1 to sell. When the system is in cash, cash earns 0%. We do not model taxes, platform fees, advisory fees, or financing costs. And our benchmark is straightforward. We buy SPY once and just hold it through the end of the test using the same backtest settings. So, does the Connors two-period RSI trading strategy meaningfully improve results versus our buy and hold benchmark? Let's dive into the numbers. But first, a quick disclaimer. This video is for educational purposes only. It is not investment advice or a recommendation to buy, sell, or hold any investment. Any performance shown is hypothetical and based on historical data and specific assumptions. Past results are not indicative of future outcomes. Please pause now to read the full disclaimer on screen. All right, let's have a look at the scorecard and walk through the head-to-head performance metrics. We'll go section by section in the same order you see on screen. Section 1, Exposure. For Connor's two-period RSI, time in the market is 14.1%. That works out to 7.9 trades per year, and the win rate is 73.8%. For buy and hold, time in the market is by definition 100%. Trades per year and win rate are not meaningful because the position is held continuously. Section 2, Risk. For Connor's RSI, volatility is 6.7% with a max drawdown of minus 14.9%. The Sharpe and Kalmar ratios are 0.7 and 0.3 respectively. For buy and hold, volatility is 19.3% with a max drawdown of minus 55.2%, and the Sharpe and Kalmar ratios are 0.6 and 0.2. Section 3, Payoff. For Connor's RSI, the compound annual growth rate is 4.4%, and ending capital is $35,160. For buy and hold, the growth rate is 10%, and ending capital is $156,917. So Connor's two-period RSI behaves more like a low-risk, part-time dip-buying system than a full replacement for owning the index. Now that you've seen the scorecard, let's look at how those results show up over time on the equity curve. The gold line is Connors 2-period RSI, and the dark line is our buy and hold benchmark. Here's the key visual to watch. When the gold line is rising, the strategy is invested. When the gold line goes flat, the strategy is in cash, waiting for the next pullback signal. From 1996 through the late 90s, both lines move up with the bull market, but the dark buy and hold line climbs faster and ends higher, while the gold Connors RSI line rises more slowly in smaller steps. In the 2000s, through the dot-com bust and the global financial crisis, the contrast flips. The buy and hold benchmark line collapses, spikes, and collapses again, carving out deep valleys. In contrast, the Connors RSI line spends most of that decade flat or gently stepping higher, with much smaller dips along the way. By the end of 2009, the two lines are nearly on top of each other again, but the path to get there was quite different. From 2010 through 2019, you see the opportunity cost of being in cash most of the time. The buy and hold line bends into a classic compounding curve, while the Connors RSI line is almost flat by comparison, with long horizontal stretches. And in 2020 through 2024, that same pattern plays out again at higher speed. During the COVID crash, buy and hold drops sharply, while Connors RSI barely dips. But as the market snaps back and pushes to new highs, buy and hold races away, and Connors RSI continues its slow, controlled climb. Taken together, the equity curve makes the trade-off easy to see. Connors 2-period RSI gives you a calmer path with long periods on the sidelines, but by the end of the sample, it finishes far below buy and hold. To recap, we've reviewed the head-to-head metrics on the scorecard, and we've walked the equity curve, highlighting how this trading strategy behaves over time. Now let's take a step back and talk about what it can do for you in terms of benefit, cost, and what role, if any, this strategy could play in a portfolio. The main benefit is path control. Connors 2-period RSI is 1/3 the volatility of our buy and hold benchmark, with max drawdown in the mid-teens instead of the mid-50s, and it spends over 85% of the sample in cash. On the equity curve, that shows up as a slow, steady line with shallow dips, especially in the multi-crash decade from 2000 through 2009, where it ends up in nearly the same place as buy and hold, but gets there with far less trauma. If your primary pain point is large, multi-year drawdowns, this kind of RSI mean reversion system can make the ride much easier to live with, without introducing short selling or leverage. The cost shows up at the finish line. Because the strategy is only in the market 14.1% of the time and targets small short-term bounces, the long-run return is far below simply owning SPY. On the full-period scorecard, buy and hold compounds more than twice as fast and ends with much more capital. On the equity curve, you see that gap open up during the long post-crisis bull market and again after COVID. Each time Connors RSI steps aside during a pullback, then re-enters after part of the rebound, more of the long-run upside migrates to the benchmark. Given all of that, what role is Connors 2-period RSI best suited for in a portfolio? It makes sense if your goal is to add a controlled, rules-based way to buy sharp pullbacks in an index you already own, with tight trade-level risk and shallow drawdowns, and you accept that the price of that comfort is a much lower terminal wealth number than buy and hold. However, if your objective is to maximize long-run index-level growth and you can tolerate deep drawdowns, simple buy and hold remains the cleaner benchmark, as long as you remember that these conclusions are based on this single asset SPY backtest. At Backtested Strategies, we always include a short bonus section at the end of our videos for viewers who want a tuned variant of the same idea. So thanks for sticking around. For this Connors 2-period RSI strategy, we ran a parameter sweep, and one configuration stood out in this historical window. We'll show the results right now, and to receive the tuned parameter pack for this test, go to backtestedstrategies.com/RSI2. The link is also posted in the video description. We'll go section by section using the same grouping as the scorecard. Section 1, Exposure. For the standard version, time in the market is 14.1%, with 7.9 trades per year and a 73.8% win rate. In the tune version, time in the market rises to 30.3% with 17.5 trades per year and a 71.1% win rate. So the tuned version participates more and trades more frequently with a modestly lower win rate. Section 2, Risk. For the standard version, volatility is 6.7% with a max drawdown of minus 14.9%. The Sharpe and Kalmar ratios are 0.7 and 0.3, respectively. For the tune version, volatility is 8.8% with a max drawdown of minus 14%. The Sharpe and Kalmar ratios are 0.7 and 0.4. So risk stays in the same general range with higher volatility and a slightly better Kalmar ratio. Section 3, Payoff. For the standard version, the compound annual growth rate is 4.4% and ending capital is $35,160. For the tuned version, the growth rate is 5.8% and ending capital is $51,910. The takeaway isn't that there's a single perfect setting. These results are based on this specific SPY history and set of assumptions. The point is that small systematic parameter choices can materially shift the balance between return, risk, and trade frequency, even when the core logic stays the same. Remember, go to backtestedstrategies.com/RSI2 to get the tuned parameter pack for this backtest. We'll email you the exact settings and implementation notes. Click the video on screen to watch the next backtest and subscribe for future episodes. Thanks for watching Backtested Strategies. Real tests, hard data, no spin.